Hey guys, how you doing? It's Will Caban, the Mortgage Man. So I wanted to just go over really quickly, how does a mortgage forbearance report on your credit report? We've heard many stories of why you shouldn't go into forbearance, some of the pitfalls and some of the things that you should be aware of. So just to kind of backtrack, as you guys know, forbearance is an option for people who are in a position to try to, float some mortgage payments for a few months. And I believe right now you can go up to 6 months. But we've been cautioning people to do that mainly for the reason that I want to talk about right now. So the first reason is because it negatively affects the way that a mortgage can report on your credit report. So one of my colleagues, Andrew Cady, he ran across the situation personally, and what it was a scenario where a mother-in-law had co-signed for her son, and basically her son went into forbearance. She was looking to do a refinance on her mortgage, and when we pulled her credit, it ended up happening that there was a forbearance on the credit report. But the crazy thing is that there was no mortgage payment that was reporting on the credit report. And when you look at mortgage lates, when you look at mortgage payment history, one of the most important things to look at and we factor in is mortgage history. So to kind of backtrack, we had no option for refinancing for the client, unfortunately, because of the fact that the mortgage payments weren't accurately reflecting on the actual credit report. There was another scenario where we actually pulled credit, and it negatively affected the credit score. But I also wanted to go into this a little bit more deep, because not only did it affect the credit score negatively, but it also reported as late payments for forbearance. And let me just show you guys exactly what I mean. You're looking right now at a credit pull from a client who went into forbearance, and as you can see, there's a 30-day late that's showing up, and clearly it says account is forbearance, Freddie Mac account, and you're seeing it with your own eyes that this is something that is being reported as being late. Now this actual scenario dropped by, I think, 88 points was the point structure that it had dropped. So significant drop and point reduction just by being late 1 month, or at least reporting late 1 month in the forbearance period. So there's really no set determined way that a servicer has to report your credit. So if you go into forbearance, they can report it as you see one scenario where they essentially just don't report the mortgage payment. Another scenario, like you saw, they reported a late payment. And what that does is it negatively affects you in both scenarios. Now, the most important thing is it really restricts you from being able to refinance. And the reason why it does that is because there's no guidance right now, no clear guidance at all, that basically stipulates whether you'd be able to refinance within 12 months or 6 months after your forbearance period. Because if the servicers continue to show your credit history as far as your mortgage payments are concerned as late payments, the guideline specifically says that you have to have 12 months of no late payments for the last rolling 12 months. So that would restrict you from the last date that you're late. So one of the biggest issues and one of the biggest things that we're going through right now is how is this going to be handled and dealt with forward in the future? And no one really knows right now. But just wanted to give you guys an idea of what it looks like when you go into forbearance and some of the things that you need to be aware of how it affects your credit, how it reports, and the potential pitfalls for anyone trying to refinance later on. If you guys have any questions about anything, as always, feel free to reach out to me. Will Caban, the Mortgage Man. Take care.